Hi, everyone. Welcome to the TimingResearch.com Analyze Your Trade, episode number 143 for November 10th, 2020. My name is David Kosmeter. I'm the creator of TimingResearch.com, and today we will be discussing your trade ideas. So we are recording this at 4 p.m. Eastern Time, and you should be seeing the screen of Carley Garner. She's our guest for today. And Jim, the option professor, is back to moderate, so I'm going to go ahead and turn it over to him.
Okay, great. And thanks everybody for being here. Big week so far, a lot of action. And Carley Garner is going to give us an update on what she's seeing and what she is thinking looks pretty good. Before we get started, for people who are not familiar, Carley, could you give the background on yourself and also what's going on at thecarleytrading.com?
Sure. So I am a futures and options broker. So we deal in trading futures. So that can be stock index futures, metals, currencies, grains, meats, just about anything you can name on the board, as well as options. To be honest, most of our clients are option traders. We tend to attract that type of trader because option trading fits my personality best, but we do have some futures traders as well. So what we're going to talk about today is mostly just some of the ideas that we have looking across some of the futures markets. You can apply this to your futures trading or options trading accordingly. We'll probably be taking mostly a big picture look at things because it's been, like you said, it's been an exciting week and things are moving, but sometimes it's hard to take a step back and look at what's going on in the overall scheme of things, and when all these, when you're getting such crazy price bars intraday. So that's kind of what I'm hoping to get across today.
Sure. As far as just talking about one thing you mentioned, that a lot of your people like to use the option market in lieu of the futures. Would that be because of the limited risk nature of it, or would it be the many, many different ways you can adjust risk with the options?
It's a little bit of both. So just to be clear, option trading can be limited risk or it can be unlimited risk depending on the strategies you employ. Some option spreads do entail unlimited risk, or if you're selling options naked, there's unlimited risk. So we have a little bit of everything as far as that goes. The reason I personally favor option trading is because it takes a lot of the emotion out of things. That you don't have to worry about getting stopped out. You don't have to worry about margin calls if you're trading long options or option spreads with limited risk. And it just really honestly slows things down. And I'm not saying, there's no right or wrong way to trade the markets. If you can find a way to make money, that's the right way for you. But for everybody, that's a little bit different. Some people like the simplicity of the math of futures, because futures are a lot easy to figure out how much you make or lose once you get into a trade. But it's also a lot more stressful for some people like myself. So for me and for many of my clients, it takes a lot of the emotional turmoil. And the thing is, trading ultimately is a mental game. It doesn't matter how good you are at analyzing the charts. If you're mentally not capable of making good decisions, you're not going to make money. It's really that simple. And so for some people, I think that option trading puts them in a space where they can sleep at night and they're not overthinking things and things like that. So, but again, it's a personality thing.
And most of the traders, are they more into the swing type trading, which would be weekly or maybe a month or so, or are they doing more position trading, or are they combinations?
I mean, honestly, we have hundreds and hundreds of clients, and so we have really everything across the board.
Gotcha.
We do make recommendations for our clients. Like if you're a client of ours, we send out newsletters with commentary. We also give them trading ideas. Some of the ideas we give to our clients, we also give to Bloomberg about once a week. Actually, I'm going to be on tomorrow afternoon if anyone happens to be around their TV at around 3:15 p.m. Eastern. We'll be putting out a trade idea on Bloomberg. So honestly, like I said, we have a little bit of everything on our books, but as far as the trades that I tend to recommend to people, usually the time horizon is intended to be, I'd say 2 to 4 weeks. Sometimes they're shorter. Like if we happen to just get in and it works out real well in a couple of days, hey, nothing wrong with jumping out and taking the money. Sometimes it goes longer than we expect, but the idea is usually 2 to 4 weeks, I'd say on average is what we're looking for.
Great. Well, we're going to go to the futures, but what we're going to start out with is the list. And as I look at the list, it looks like a lot of people are interested in stocks that were going up really big because of work at home and that kind of thing. and they're probably wanting to know if the high multiples, will get hit more. But let's start out with the top of the list, which is obviously the poster child for the work at home, stay at home, whatever, Zoom, ZM.
Okay.
And we obviously saw that go to $600 a share. And then somebody started handing out coffee. And the next thing you know, the cop showed up, and then it was $379. So
right.
What are we thinking about Zoom here?
So, I mean, to be honest, I don't follow the individual stocks. I know that's going to be really big downer for you.
So we can just talk about the technicals as you read them. How about that?
Yeah, I can talk about the NASDAQ. Is that good?
Oh, okay.
Does that work?
Okay. Okay.
I can talk about Zoom and Amazon stock, but honestly, my opinion's not any better than anyone else's. I have no idea what I'm talking about.
All right, so let's look at a broad-based index and then basically take it from there. Like I say, I think at this point, the technicals are probably pretty important on a lot of this stuff.
Sure. So this is what I look at when I look at a NASDAQ chart. So this is the NASDAQ futures, and obviously it has been a spectacular couple of years here. Anybody that's tried to sell the NASDAQ is obviously probably not been successful unless their timing is real good and they got in and out, so on and so forth. But overall, the money's obviously been made on the long side. Whether or not that continues, I have serious doubts. And the reason I do, not necessarily because of the NASDAQ chart, but I look at the S&P chart, which we've been staring at all day. Our technical models apply, or I should say they work quite a bit better in the S&P than they do the NASDAQ or the Russell, because it's a broader based index and it's a little smoother and it just tends to follow the rules a little better. But generally they both go in the same direction. So with that in mind, this is a monthly chart of the E-mini S&P futures. So it does, if some of you are stock traders and you're not familiar with how the futures work, the futures trade 24 hours a day. So if you're charting the E-mini S&P, it's a much more complete picture than if you pulled up like the SPY or the SPX, which is only trading during New York Stock Exchange hours. In the E-mini S&P, we can see exactly what happened just a few nights ago. This is a weekly chart. I apologize, not monthly. A weekly chart. We had actually been talking about a target of 3660 to 3700 for months now, and everybody thought we were absolutely completely crazy. But the only reason we thought it might get there is not because we knew the economy was going to jump after coronavirus, none of that. It was literally just looking at the chart. We've been putting in this megaphone pattern here for years now. The top of that megaphone pattern is right exactly where we peaked out yesterday. Some will try to tell you that we are going all the way back down to 2000, 1800 in the S&P. I'm not going to rule that out, but I don't think that's likely. I think we're probably going to break the cycle of this pattern, and I think we probably get back to a little more normal volatility, but could be wrong. I hope I'm not. I do think, though, the market it's almost like all the good news is out. We've gotten coronavirus, positive news. We have antibody treatments. We have a vaccine. I mean, I know it's not a done deal and there's a lot of stuff going on, but the reality is sometimes buy the rumor, sell the fact. And I think that's kind of what we're getting. Also with the election, there was a lot of uncertainty there. And even though there's still a ton of uncertainty hanging over us, amazingly, the market is focusing on the fact that really regardless of who actually wins the presidency, there's probably going to be a lot of gridlock in Washington. Mm-hmm. The tax cuts are probably, the odds of them being repealed are probably not so great right now. But all of this good news is probably priced in. And so I think the market's really going to have a hard time doing a whole lot more on the upside. We're also looking at RSI divergence. If you're not aware of what divergence is, it's basically when the market makes a new high, but the indicators don't. You can see here in January, the market made a high, RSI made a high, but on the new highs since then, RSI has lagged. That happened once before. Well, it's happened many times, but recently it happened in 2018. You can see the market peaked in early 2018 at the end of the year. We made a slightly new high and then we fell apart. Now, usually this time of year, the market rallies going into the holidays, and it's usually just thin trade and melt up kind of action. That's what happens on most years. But in 2018, it was the exact opposite. We had the RSI divergence, we had a new high, and the October area, and then from there it literally just melted down. I have a feeling, I could be wrong, I mean, nobody has a crystal ball, but this feels a little like how 2018 did. And so I'm wondering if this year the seasonal pattern is gonna go the opposite direction, but we'll, time will tell.
Yeah, the fundamental behind it is how heavy the tech sector is in the S&P, and the tech sector had pretty much a valuation rally because the P ratios on things like Apple went from like 20 up towards 40, and that was based on interest rates extremely low. And now that the interest rate environment has changed a bit, you have to change the valuation model. So it could be a deal where the value stuff that I've been pushing for the last 6 months will actually hold up fairly well because their PE ratios are 14 and 15, and they pay dividends of 2 and 3 and 4%. And so it may go down, but not everything may tank as much, but it may be hard for the market to go up without tech, right?
Yes, I think you hit it right on the head there. The stocks that have been outperforming are probably going to, I mean, this again, who knows, is opinion, but I do think they will probably start underperforming. And some of the stuff that's been lagging, for example, I don't follow stocks, so take this with a grain of salt, but like bank stocks, I think will start doing better, not because I'm an expert on bank stocks, but because the interest rate market is probably, it's probably working out a little better for them now as it was just 6 months ago. And I do follow crude oil very, very closely. And I know the energy sector has just been just lagging and painful for anyone that's invested there, I myself included. So I do know exactly how those stocks have been behaving, but I do think that if you recall in March, crude oil was trading in the 60s right before the coronavirus area. Well, actually 60s in January.
Yeah.
The coronavirus came, all heck broke loose, and what happens is the demand destruction literally almost overnight just took the demand away, but supplies were still, all the rigs were still up and running in the US. We've basically put to sleep 70 to 80% of our rigs.
Right.
Now, when demand comes back, which I think that my personal opinion is we're turning the corner, like, we said before, vaccines, treatments are getting better, so on and so forth. Here in Las Vegas, I can tell you it's like someone flipped the light switch on. Suddenly people want to come and have fun and spend money. There's restrictions where everyone's wearing masks, there's temperature checks, but people seem to be just living with it at this point. So things are getting better, demand will go up, and I feel like the supply of oil is probably the increase in supply is going to lag, and that should put some upward pressure on oil itself, which should enable the energy stocks, which have been lagging, to either hold up or maybe even dramatically outperform the rest of the market.
Yeah, and that's a sector the ETFs pay over 6% dividend, so that's not a bad yield while you're waiting for the recovery to stick a little bit. And you would look at that 35 area as a pretty good base.
Yeah, absolutely. So this is kind of the chart we've been looking at for the last couple of months. This is a daily chart, by the way. So this is more of a shorter term. We did break down a week or so ago, but crude oil is a messy market. That's just honestly how it is. If everybody gets a little too complacent or too long, we flush out, run the stops. And honestly, I think that's what it needed because it had been trading in this very tight range. Now that we flushed out all the weak hands, I think we probably go up. The real test is going to be in the low 40s. So like 42, 43. If we can get above that, I think we're going to easily see 46, 47, maybe even much higher. So we'll see.
Yeah, next spring or summer, if everyone's doing the more normalized behavior, 50 to 55 is not off the table either.
Oh, absolutely. Actually, if we're going to talk summer, I'm thinking 60.
Yeah.
So it's not impossible. The thing is, I've been following crude for a long time. Let's look at a monthly chart real quick. Crude does this. This year was a little more dramatic because of coronavirus, and we had some issues with the front month contract going negative, but the back month contracts really never traded below 20, except for maybe a few minutes. So for the most part, it was an 80% decline. We've seen 80% declines over and over and over, and every time it gets down to 20s, 30s, People think crude oil is never coming back. That's the end of crude oil. And guess what? It always goes back up. And I actually especially feel that this time around because I'm old enough to remember in 2007, 2008, when crude oil was up here in the $150 range. Nobody, and I'm telling you, Goldman Sachs, the biggest, smartest guys on Wall Street, nobody saw the collapse down to 20, 30 coming. It just, everybody was talking $200 oil. And the story was, we were running out of oil. We didn't have enough oil. You know, this is a major catastrophe. But I feel like we're at the exact opposite point, or at least we were in March. The story is so much different now. It's not that we're running out of oil. It's like nobody wants oil anymore. Everyone's going green. That oil's old news. Everybody's moving away from fossil fuels. But the reality is I don't think it's going to happen that quick. And we haven't perfected the green energy, in my opinion. So I think fossil fuels, at least for now, are here to stay. And I think that was probably just the trough of pessimism, just like 2008 was the peak of optimism. So I think oil's got a bright future ahead.
With regards to the bond market, there's a similar story there in that 1981-82 with Volcker was interest rates will never go down. And this March, it was interest rates will never go up.
Right.
So we had a full 40-year cycle there. And are you seeing that there's a potential that the high in the bond market, or you're looking at the 10-year, the high in the 10-year and the low in the yield of March may not be seen again for a while?
I believe that is probably going to be true. Now, for full disclosure, we actually recommended to our clients yesterday to purchase call options in the 10-year note.
For the bounce back?
Yeah, we're looking for a bounce back. Seasonally, November's usually a pretty good month. Also, I think there's still a lot of fundamental uncertainty going on.
Right.
So I do think we bounce in the short run, but in the long run, this is exactly what I'm looking at. And I think we're going all the way down here, which means much higher yields than what we've got here. Now, these kinds of things, this is a process. It's not something that happens overnight, obviously, but I do think that
it would correlate to your story of the possibility that the stock market had a blow off top on Monday that may be resolved with some type of corrective activity between now, maybe in month's end, or now and the beginning of December, something like that.
That's what I'm thinking. Yeah, absolutely. And to your point, you're right. Everybody has just kind of accepted the fact that interest rates are low, and they've even accepted the fact that, hey, interest rates might go negative, which I don't think is going to happen. And the Fed said they're not willing to do that. But anyway, people have kind of gotten in that mindset that this is the new norm. And usually when everybody starts to agree with a story like that is when it's ending. And so I do have a feeling that we've probably seen the low in yields, and I think we'll hopefully slowly and tamely work our way back up.
Yeah. Can you put the S&P chart up, and we could opine on some of the potential. First of all, do you ever use anything with Elliott wave? Because there's some Elliott waivers out there that are have been saying, I don't know what they're saying now, but they had been saying that the middle of November, which we're almost at, and the middle of December, before the Santa Claus rally, we were going to get a very good sweet spot. Do you see anything like that possibly? And what levels? They were thinking 30-50 might occur. But what's your opinion?
I think 30-50 is kind of the number I was looking for if we do get a big correction. So my thought process is completely different than what theirs is, it sounds like. But I do think here's what I'm looking for. I'm not one that thinks we're going back down to 2000. I think if the people that were savvy enough to purchase, buy in March, they're probably not going to get that opportunity ever again. Probably, maybe even in our lifetimes, we might not get that.
It's like an 08 deal at 666.
Yeah, exactly. I mean, that was just incredible, but it's gone. Don't wait for that. That's my thought. I do think we can get a pretty healthy correction. There's definitely a lot of crazy stuff going on.
Yeah.
And my target would be like just a normal back and fill would probably put us somewhere around 3,300, which is 350 point pullback. I mean, it's funny to talk about these numbers because if you look at a chart, like let's scroll back here into the 2016, we're moving more in a couple of days than we used to move in
Oh,
a
yeah.
year. So
Yeah.
it's just really, really wild.
Oh.
But I do think that we'll probably see a good size pullback that could go as deep as 30.50. My more likely target might be about 31.85, but I absolutely wouldn't rule out 30.50, especially if it happens here going into the end of the year. We all know with the holidays, markets get light and thin and weird things happen. That's exactly what we saw in 2018. I'm sure a lot of you remember the market just kept melting and melting and there was no end in sight until Christmas Eve. It just turned around and went right back up. So
it seems like everyone's trading on an all or none ticket, meaning they want it all in or they want it all out. And the guy who's doing the market making, like yesterday, said, you all want to come in? It's 3,600, all you can eat. And then they
yeah,
know very well the probabilities are that you're not going to repeat that kind of volume the next day. So once they
right.
fill all that stuff, you got to find another group who wants to pay the all-time high at that kind of volume, or else it falls under its own weight. So I was trying to explain to people that, you know, when you get extremely high volume and extremely high prices, you are looking at a situation where if it's not repeatable, then it can't last.
Right.
And again, you saw that during the crash when when everybody in the world wants out, they just drop the bid to some price where they know if I take all this in and there's nobody behind it, it's going to snap right back up.
Yep.
And
Oh,
so,
absolutely.
you know, that's sometimes, you know, people have a hard time understanding why the volatility can be so big. It's because somebody's got to be on the other side of the trade.
Right.
And if they see a real steamroller coming, they're not going to give you a good price. They're going to give you the worst price they possibly can, you know?
Sure. Yeah, absolutely. Well, and it's a situation where people are like in March, people were selling not because they wanted to, or at least I should say in the futures market. And the stock market, that's different. They were selling because they were scared and they wanted to sell.
They want
But
their
in
cash.
in futures, it was more of a margin situation, I think, for most of them. So they were selling because they had to. They were out of margin, and the margin man liquidated them, not necessarily because they wanted to. But that's unfortunately how things are, especially now. I think with the algorithms and computer trading and all those sorts of things, it really just speeds things up and exaggerates everything. And so you have to be prepared for those kinds of things.
It swamps the volume. You know what I mean?
Sure,
The algos come in and they want to do 9 million trades in a market that can only take a bid of 2 million. And you don't have to be a genius to figure out with that imbalance what's going to happen. Yeah.
Right.
Well, there was some people talking about the old GLD here, and you know, I've been following that. I thought that $2,130 silver stuff might last for a long time, and so far it's lasted pretty long. But you know, is this pullback to you going to hold 1,800 area, and we're going to go right back up, and the silver going to hold 22 and go right back up, or do you feel like there's more wood to chop here?
So I think we may chop around and trade sideways for a little longer. That said, my bigger view is I think the metals have probably already seen the highs for quite a while, maybe even several years. We've seen this before in gold and silver. They have these miraculous rallies and then they just can't hold. And I mean, the last time we saw gold do this, investors had to hold on for 10 years to get their money back if they bought near the highs in 2011. Honestly, I wouldn't be shocked to see something like that. I mean, time will tell. But I do think even just if we look at the previous rallies in gold and corrections have been pretty big, 24 to 38%. So it's right now we've only corrected like roughly 10%, I think, off the top of my head. So I think we're going, even if the market's bullish and we're going back up, I think a normal correction would be about 1,500. So I know that sounds scary for people that want gold to go up forever, but that's the reality. And I do think the dollar's probably bottoming again. I could be wrong, but what I think is going on is the interest rate differential in the US is favorable. I mean, if you're trying to buy any type of quality fixed income overseas, you're getting nothing in return. And at least the 10-year here in the US is yielding almost 1%, which is low, but it's probably worth jumping overseas for. And our stock market's performing better. And so I think that's going to lure some overseas investors into the dollar, keep it up. And if that's the case, it's going to be really tough for gold and silver to make much on the upside.
Yeah. Why don't we talk a little bit about the dollar index? Because option professor,
Okay.
our view was that the buy signal to get into stocks, get into gold and silver, get into the euro occurred when the dollar index broke under 100 back in April and May.
Hmm.
And now this 90, 92 area, call it 92,
Sure.
that's a neighborhood where, if you've noticed, we've not made tremendous progress since August, and that's when
Hmm.
it bottomed at 92. And if
Right.
you're correct, and we're going up towards 94, 96, that would
Hmm.
be somewhat difficult for stocks, the gold and silver and the euro. So how do you feel there?
Yeah, no, I agree with you 100%. So this is a monthly chart of the dollar index that trades on the ICE exchange, the dollar index futures. And as you mentioned, we've kind of been hovering here for 3 or 4 months without much progress. So maybe we do melt down, but I doubt it. I wouldn't be shocked to see kind of a flush lower, something like what we saw in crude oil a few weeks ago, just to run the sell stops and shake
Mm-hmm.
out the weak hands and that sort of
Mm-hmm.
thing. So if we take a real sharp dip down to 91, don't assume that that's a meltdown and we're going down from there, because I don't think that's going to happen. I think if you look at the stochastics down here, and I know that's not the end all be all indicator by any means, but it's had a pretty good record in the dollar, and I think that we'll continue to kind of hold this support, even if it does
Mm-hmm.
flush down a little bit and continue higher. Maybe even as high as 105. I'm not sure we'll get quite that high, but even if it goes into the high 90s, like you mentioned, it's going to really be a huge headway for commodities and stocks.
Yeah. And the yield advantage that went away when in March, when we went to almost zero interest rates. We were in the pool with all the ECB and the BOJ with no rates. So that yield advantage is now coming back.
Right.
And
Yep.
that's, of course, another positive for the dollar. Not only
Correct.
that, crowded trade is a very good thing to remember. Crowded trade, and like Zoom is a crowded trade, and Tesla got to be a crowded trade. Gold and silver a crowded trade, and being negative on the dollar is a crowded trade. And
Sure.
unfortunately, crowded trade sometimes, end up going the other way because you can only go one direction with so many people until it dries up a bit.
I agree. That's the one thing I look at religiously is I look for crowded trades. I look at the COT report to see how traders are positioned. I look at Twitter and social media to see how they're thinking. And you're absolutely right. I can't think of very many people that think the dollar is going to go up, which makes me want to think it's probably going up.
And it could be a safety trade. If the stocks do
Sure.
start coming off for whatever reason, the reasons could be the virus starts increasing hospitalizations and deaths. It could be the stimulus package never gets done, or it gets done with a penny or two. Or it could be that the Trump challenge turns into Nightmare on Elm Street.
Yeah, that's
Yeah.
true too.
So
Yeah,
there's
absolutely.
plenty of stuff to be concerned about, because most of these vaccines and therapeutics, are not really widespread developed right now. Let's talk about something that I really thought was a great bargain in the $8 range because of the Chinese were coming. You heard the Russians are coming. The the Chinese were coming, and this is soybeans.
Okay.
The idea was
Mhm.
China was going to do a lot of buying. Well, in Q3, their buying of soybeans increased 63%. So obviously they did
Right.
show up.
Hmm.
And today we had another big day. Is this going to be captured in the $10 or $12 range, or is this going to really, have a bigger outcome? Soybeans.
Well, for full disclosure, I thought the 1050 would hold, and it did not. You can see I've
Mm-hmm.
got a little circle here
Yeah.
marked, and it looked it looked like it was at first, and then it just didn't. Um, I've been a little surprised by this rally, because honestly, it took place during a time of year that we generally are doing the exact opposite. So while I
Mm-hmm.
was looking for harvest lows, market's putting in annual highs.
Mm-hmm.
I personally think that we're probably going to hold the 1150 area, but I mean, I wouldn't want to be short this market. If you're going to play the
Right.
downside, do it with options and limited risk. Don't try to jump in front of the freight train. I've seen what grains can do to people on the wrong side if you don't have risk mitigation in place. If you're looking to buy it, I'd be a little reluctant to buy up here as well. You probably missed the boat. You're probably better off waiting for something else. But with that said, if it does break above 1150, we're looking at 1220. I
Yeah.
would be shocked if we got above 1220, but that doesn't mean it's impossible. Nothing's ever impossible. But again, if we go back to the dollar, if the dollar strengthens, that's going to kind of put a damper on some of these grains.
Maybe it's not a bad time between here and 12 area to start looking for a formation to sell against. If you're a believer the dollar would pick up, rather than just stepping in front of the freight train here and just hope this is a high. Maybe there'd be
Right.
some kind of formation that could develop either on a 5-day or a monthly graph where you could trade against it, like a high with lower highs around it. At least you got a point to defend against,
Right. I agree.
something like that. Well, that was a big one. Excuse me, that was a big one. The other one that's been kind of looking pretty good lately, ever since it got above these 50 and 200-day moving averages, is sugar. You see anything happening there?
So I don't have a strong opinion about sugar from this particular price. If we get up to 16 cents, maybe even a little higher than that, I'd be pretty comfortably bearish. Right here, I'm not quite sure what to make of it. It's just not quite to any of our resistance levels yet. But I mean, this is probably not the place to be aggressive one way or the other. So I'd do something. If I had to make something go here, I'd probably just use a straight call or a straight put, leave it with limited risk and see what happens. But
let's take a look at copper, because everyone, another crowded trade is obviously the home builders, which I've been explaining to people has probably seen its best days for a while. Copper, is that a double top up at 325, or is it going to blow through that level and we're going to have 97 more homes built?
Sure. So we tend to be bearish copper here. I think this is kind of a last hurrah rally. We'd been pinpointing the 320 area. The fact that it sold off and came back makes me wonder if we're not going to test 330. If we do, it'll be something that's probably just a quick probe higher, run the buy stops kind of thing before rolling over. But I do think this level holds. I mean, you can see this is kind of a pattern that we've got going on here since 2017. So it's been in the making for 3 years. Because I feel like the stock market's probably priced in all the good news, I think copper is going to follow suit. It tends to be pretty highly correlated with the S&P. So I think the upside's probably limited from here.
Here's one that we were very happy with earlier in the year, because we thought anything under 100 on coffee was a steal. And it went from under 100 to 137, which was not a steal. That was overbought. And I'm sure it had I bet you it had an RSI divergence when it went from the 130 high up to the 137 high. Do you see a divergence back then when, between those two numbers there, a little divergence?
Maybe, not so much, but yeah, I think you had the right idea there.
Does it look to you that if we broke 110, it could get back on the bicycle in a big way, or no?
I do, yeah. So we've got this little trading range here, and I agree with you. If we break up above, I'd say about 110, maybe 113 to try to get above this high. It could be off to the races. Until then, we may just kind of chop down. I'm hoping that we get one more trip down to the lower end of the range and maybe even the 100 area so that we can get something off, but the market might not be willing to allow that. So we'll see.
Yeah, they said, what I've read is that most commodities are undersupplied except for coffee, cocoa, and some other one. So in other words, supplies are rather tight, and the supply demand dynamic is pretty positive in commodities, except for this one here. And that's one of the reasons probably why it's had some hard time, making a go of it.
Sure.
You doing much with, some of these markets like coffee are very thin, hard to work with the options because the bid-ask spreads are 9 miles apart and it's hard to spread them. But natural gas, just to talk about it, another one that's a rough racket to work with. But
Sure. So actually, natural gas options have actually gotten better over the last handful of years, so they're a little easier to work with. I mean, they're not, it's not crude oil yet, but they're workable.
But they're not as bad as lumber, right?
Oh gosh, no, lumber is terrible. Even the lumber futures are even thin.
Yeah.
I always tell the story. Of course, pits don't really exist anymore except for a few small pits in the grain options. But in the early 2000s, I was on the CME floor and I walked by the lumber pit, and it was like 2 guys reading a newspaper and playing cards, and that was when I knew lumber's not the place. That's not the place to be. Yeah. So this is a natural gas chart. This is a daily chart, so it's shorter term. And we actually have, we had recommended this trade. These lines represent a butterfly spread that we have on. To be honest, we've had this on for quite a while. I think we put it on back here in September, maybe. And what a butterfly is, if you're not familiar with it, we bought the December 325 puts. So that's what this line is. We sold 2 of the $3 puts, and we bought the 275 puts. So in a nutshell, what it ends up being is a range trade where we make money anywhere between, I want to say we paid about a nickel to get in, but don't quote me on that. But so what that means is we make money anywhere from basically 320 down to 280. So as long as it stays in that range, we make something. To be honest, the market's been so volatile that spread, even though it's been in our profit range the whole time, we haven't really made or lost much of anything because the premiums are just so out of whack. But we're starting to get down to the last couple of weeks of expiration, and I'm hoping it pans out. And so what we're looking for is for, really, I think natural gas is just going to hover in this general area. So somewhere between 320 and 280-ish, 290-ish, I think is where we stay, unless something out of the ordinary happens. I mean, we all know how explosive natural gas can be on the upside, especially during the winter, but usually that type of explosiveness occurs in January, February, not so much November, December. So I think we trade sideways for a little while. If we do get deep into the winter with prices in this area, I'd probably be looking to play the upside, because almost every year we do get some sort of weather surprise at some point. Sometimes it's just temporary, but you got to be in it to win it. So
What about silver prices? You know, it had that big run up. The breakout was clearly 18 to 20. And then on the pullback, this 22 number has been hanging in there. And it seems like 26 is resistance. It's the former lows of a few months back, and it's obviously the recent highs. So that 26 neighborhood looks a little bit like an important neighborhood. So what are you thinking here?
Yeah, so I personally think the $30 area was the high for quite a while. I think we just kind of dribble our way lower, similar to my thoughts in gold. You're right, 26.50, 27 is the new resistance, and I think that'll probably hold. I'm looking for silver to eventually make its way down to about $15. So this line right here. I know that's not the most popular opinion, but that is what I think. I remember in a few months ago when silver was trading in 25, 30 area, I did an interview for Kitco, and I mentioned, and I honestly didn't necessarily 100% mean it, but just for entertainment purposes, I said something like, I don't think silver will see $50 again in my lifetime. And I was partially kidding, but the point was I thought the $30 would hold and we'd struggle from there, which did happen to, so far that's worked. Maybe that'll change. But the reason I bring that up is I received like hate email and death threats on Twitter.
It's
People
like
really
politics.
love,
If you take Biden or Trump, you get
right.
get half the people doing one thing, half the people doing another.
Yes, people are really sensitive about gold and silver, so it's
as much as they are about politics.
Yes, they are.
Yeah. That dollar index is going to be the key. You know, I think you would admit that if it started blowing out 90 and you started seeing 88, 85, then obviously it would open the door to the higher metal prices, because the dollar would then be supporting the concept. But if the dollar can't drop, then it's very difficult for this gold to get going.
Right. I agree 100%.
So that's why I like to tell people to keep an eye on the dollar index, because, if it's not going down anymore, stuff that went up during its decline, probably may not go up as much as before,
Absolutely.
What else could we cover here? We're kind of hitting all 26 areas here. Why don't you just put up lumber so people can see what lumber prices have done? Because it might be an indicator on the housing situation. Because since we peaked in lumber, stocks like Lennar Homes, you had a little bit of a bump into the October timeframe, but they've been a little bit defensive. Today they had a good day, but
right. So this is lumber, and this is an interesting time to look at lumber, because we've just seen well, I'm not an expert in lumber, but I think this is the largest rally we've ever seen in lumber. I guess I'd have to go back and look at a long-term chart. I might
certainly going to be in the running, huh?
Yeah, it's up there. It's in the top 5. We'll put it
Yeah.
that way. So you don't have to fact check me. I'll just leave it like that.
Mhm.
But just to give you an idea, on the margin on lumber, you know what? I don't know if you can see my other screens. I hope you can't. But I'm gonna just check the margin real quick. Yeah, they
I would
still have it
imagine. I would
really
imagine
low.
they're substantial. No, they're low.
That's what's crazy. It never really changed much. It's actually $1,760, believe it or not,
That
which is
probably has a lot
insane.
to do that it's mostly commercials, huh?
That's exactly right. Very few speculators even touch it. I had trust me, I had clients calling off the hook wanting to buy lumber when it was at like 750 because that's when the news starts talking about it, because it's at near all-time highs and people get excited. But just to give you an idea, the rally that we saw from June to the September high on one futures contract, you would have made or lost $46,000. That's how much money was getting pushed through there per contract. And of course, the correction was $35,000. So we're talking really, really big swings, and it's not even as easy as it looks, because there's a lot of limit up and limit down moves. Lumber is very thin. There's not a lot of people buying or selling. I mean, it's hundreds of, like if you look at the S&P, people are trading millions of futures contracts a day. In lumber, it's hundreds, not millions, hundreds. So just because you're long doesn't mean there's always going to be somebody to take the other side of your trade if you want to sell at a good price. I mean, you can always get someone to take it at some price, but it's probably going to be something that you might shed a tear over. So when things get volatile, it's really hard to get in and out of lumber, which is why I'm kind of surprised the margin is that low, but it is what it is. So
I tell you, there's something going on internationally that might be interesting to people because they can play it with stocks or futures, and that is basically the collapse. Well, not a collapse. Let's just say a sharp sell-off in the Japanese yen, and the new highs that have been breaking out after 20 or 30 years in a range on the Nikkei. So how about showing the Nikkei versus the yen?
okay.
And are they devaluating their currency a bit to try to get their stock market to run, or what are we seeing here? Because you
Sure.
can play it a bunch of different ways between ETFs and futures.
Right. So this is the yen. This is what the yen is really. The yen's a really weird currency. Honestly, I don't touch it too much just because, I mean, you can see it's kind of like snowflake thin over here, but that's because that would be the previous contract. This chart doesn't, it's not a
It's
continuous.
not a continuous, right?
Yeah, which, I mean, some people think you should only look at continuous, but the reality is just in case any of you care, if you're looking at a continuous, you're literally looking at fake news. It's just like the computer. Yeah, anyways. So this is the yen. It really hasn't gone anywhere in a long
No.
time. And it's a kind of market that generally doesn't move, but when it does, it moves a lot. So you can catch people off guard, which is why we don't really do a whole lot with it. The Nikkei, man, it's been a long time since I've even pulled that one up. Let me see if I can even find the symbol. Okay, this is what the Nikkei looks like. Yeah, it's had a nice parabolic move here in the last couple of days.
Mm-hmm. And if you go back in history, like we went and expanded the lens, does it look like a historic breakout?
Let's take a look here. So this is a weekly chart, and futures sometimes are a little tricky because when you do when you're looking at weekly or monthly, you are looking at a continuous chart. So like I said, it's kind of fake news. Sometimes the peaks and troughs are a little different than what happened in the
Because of
front month.
is it because of contango or?
It is, yeah, exactly. It's exactly that. And each software company or website that you go to might use slightly different continuous charts. For example, they may decide to switch contracts a week before rollover. They might do it the day of rollover. So
It's not
it's
standard.
just, yeah, correct. It's not standard, and so just be aware of it. I'm not saying don't ever look at a weekly chart because I do it all the time, but just understand what you're looking at. But I would say that's probably a breakout. I mean,
Sometimes it pulls back to the breakout point, and that's not a bad time to enter.
Yeah.
Yeah.
I mean, I'm not a Nikkei trader by any means, but
No, no.
it looks like
But the
a
chart
breakout
speaks
to
for
me.
itself, you know what I
It
mean?
does, yeah.
Yeah.
I'm not going to argue with that.
Well, there's two other currencies that I've been hearing about. Supposedly, people are saying that the Australian dollar has potential to go back to 100, and the British pound has got a bright future. And I noticed, you know, people are starting to get a little bit more bullish on European stocks and British stocks, and you
Okay.
know, they got that. So let's see what the British pound and the Australian dollar look like. Yeah.
Okay. So this is the Aussie dollar here. Let's go back to the pound. So I tend, because I have a bias, an upward bias in the dollar, I tend to look at these in a negative way. Maybe I'm a
Right.
little biased here, but
Well, the dollar goes up. It doesn't have to go up against every single currency in the world.
correct. It
Right.
doesn't. The dollar index is about 60% euro. So it's
Exactly.
mostly the
That's
euro.
right. That's
Yep.
right.
So I don't have anything against the pound. I'd say honestly, I think the pound probably is. I mean, just as a, I haven't looked at fundamentals or anything, but I would say just from a charting standpoint, I'd say the pound's probably got a pretty good shot at seeing the mid to high 30s. So I do think it's got some room to run on the upside.
Their employment situation is getting a little dodgy. People have gone from temporary, voluntarily to permanently. But if they resolve this Brexit thing, you would think there could be some kind of a reaction. Huh?
Yeah, you would think so. I think I've spent a little time in London the last couple of years, and I think they generally just want to move on with their lives.
Yeah,
And
exactly.
so, and I think it would be seen
We
as a
know the
positive
feeling.
thing. Yeah, yes, we
We know
do.
the feeling right now. We know the
Yes, we
feeling.
do. Absolutely. All right.
And the other one's the Aussie.
Okay, let's look at the Aussie.
I mean, if you expand it out, does it look like they're on a longer term basis? There could be something occurring.
So this is a weekly chart. Wow, you can see how the Aussie is actually normally very quiet. The Aussie is known as a currency that's good for beginning traders because it tends to move a little slower, but that wasn't the case in March, which was true for a lot of markets. That's a really, really big move in the Aussie. This is a weekly chart. You can see it generally doesn't go anywhere for the most part, but let me go to a monthly chart. If you look at a monthly chart, the Aussie dollar is considered a currency that is tied to commodities. It's a commodity currency. So the fact that crude oil has struggled is probably a good reason, or well, a good indicator that why the Aussie has also struggled. There's all kinds of other things going along here, but if we're right about crude oil and crude oil goes up, I think it really would put a little bit of pressure on the upside in the Aussie. And just looking at this chart, you can see the last time the Aussie got down to these levels in the 60-cent range, it turned around and almost doubled, rallied up to 110. So if I was going to pick between those two currencies on the long side, I'd probably side with the Aussie.
And one other thing is, the commodities are actually things that people use. They use gasoline, so they're going to use the crude oil and the byproducts of it. They're going to eat, so they're going to eat the corn and the wheat and the soybeans, and they're going to use these things, and ergo, you're going to have supply and demand dynamics that are going to make prices move sometimes. I noticed that the meats which people eat, pork, which would be your lean hogs, and live cattle, which would be your steak. The live cattle lately has been going up, so there could be some price inflation at the supermarket if it translates. And the lean hogs, which were in the 40s and the 50s, they're now in the 60s. So there's a big potential that the price of meat that people are used to consuming might be changing in price significantly in the weeks to come.
That it could be, but I tend to think that probably cattle is running up. This is a cattle chart, by the way. This is a daily cattle chart. Let me show you weekly so we can see the big picture. Cattle is literally at kind of its comfort zone. It's not really expensive. It's not really cheap. It's maybe a little cheaper than it is expensive, but honestly, I'd say we probably kind of trade sideways in cattle. I wouldn't be bullish on it at this point. And a lot of the issue is with the coronavirus situation earlier in the year. What happened is the cash markets were flooded with supply because everyone tried to basically send all their cattle and hogs to slaughter and just, you know, get rid of their inventory. And then and obviously restaurants weren't buying. And so it just caused a really big supply glut, which is what you're seeing with this big trough here. Not unlike what we saw in crude oil or anything else. Hogs are the same situation. Oops. We saw that big fallout earlier in the year, and then it's been kind of volatile since. But I'd say in both situations, hogs and meats, we're at a kind of an equilibrium level. You can see in hogs, the center price is going to be.
Yeah, they
right
were
around
cheap in the 40s. They were cheap in the 40s, and cattle was cheap in the 80s and 90s. But
yeah.
that train is coming on.
Correct, right. We actually, just for full disclosure, we actually have recommended put spreads in hogs for our clients. So a lot of our clients are long. This is a weekly chart, and remember I already told you they're not perfect because of the continuation and things like that, but we have December put spreads on. We're long the December 65, short the 60, so it's a 5-cent spread. So I'm not looking for hogs to just completely fall out of bed and get down to 40. I don't think we'll see that again, but I think the path of least resistance, at least for now, is lower until we get into mid to low 50s, but that's our projection.
Let's look at a couple more before we close out. The first one would be Bitcoin. We look at GBTC as a proxy for that. That's a Grayscale trust that trades on the New York Stock Exchange if you want to investigate that GBTC. But the actual Bitcoin has been doing great, and obviously GBTC has done well too because of it. But let's see if we can glean any, especially from the long-term graphs when it used to be up higher. You know what I mean? Maybe are we just going? Yeah, it does look a little rich on the other indicators, huh?
Yeah. Let me see if I can pull. I don't know how far back this ETF goes. Yeah, it does show. Okay. All right, let's go to the weekly.
Yeah, I mean, I don't have a wallet, and you know, I don't really, you know, I just like something you can call up and go, hey, could you get me in on that? Can you get me out? You know, here's my order.
Absolutely. Well, to be honest, I mean, those kinds of things aren't really, I mean, you're better off doing it in the stock market, even if it's with an ETF, even if it's a little less efficient, just simply because there's money safeguards. Like I would be a little scared to.
Yeah, that's the whole thing. I mean, if you put $1 million into Bitcoin, you thought it was a good deal and it was absconded in some way, who do you go to?
Yeah, there's nobody to hold anyone accountable. And a lot of those brokerages go belly up, and maybe they don't go belly up. Maybe they just shut down and take everyone's money. And
it reminds me of those people who say, oh, we trade Forex on the interbank market, and we're located in Antigua. I go, you know what? This doesn't sound so good to me. No FDIC down there, is there?
Right. No, I wouldn't do it with my money, but that's, I mean, the interesting thing is they do list Bitcoin futures, and they listed the futures kind of in the height of the mania when Bitcoin was at 20,000 or whatever. Yeah. Right. But it actually, and I think the futures market actually popped the Bitcoin market because at the time you could buy Bitcoin, but you really couldn't sell it. There was some sort of restrictions on selling it in the cash market with all those little wallet brokerages and all those kind of things. But once the futures came in, then people had a bona fide, you know, legitimate exchange to buy and sell, and it just kind of changed the game a little bit. But with that said, the futures market hasn't really garnered a lot of trading volume.
I heard the margin's like 25 grand, so that puts 90% of the people on the sideline right there. Right?
Yep, exactly. So they did have a smaller version of it, but it didn't catch on either. And honestly, it just, everyone wants to talk about it, but nobody wants to trade it, was kind of what happened. So it was interesting.
My conclusion is that it seems like you're buying into a tech stock in the early stage, so you might be onto something, and the world is going digital, and the millennials, which is the next group behind us here, they are totally into digital. And so the concept of using a digital currency rather than each country just printing unlimited whatever they want with all these older people's faces on the bills, you know, I don't think that's the future, as Square and PayPal has already shown you. So it merits a very small situation, maybe in a speculative portfolio, but you got to know that it could go either way. But there is very reasonable people who think it's going the northern direction over time.
Sure. Yeah, sure. And I'm not going to argue with those people. I don't know enough about it to have a strong opinion other
Right.
than I look at the chart and that's what I go off. But
And
I do think that if just this is a weekly chart of the ETF that you had mentioned. I mean, to me, it feels like it's mostly range trade. And I would
yeah,
probably be more inclined to sell it than buy it.
right.
But it'll be interesting, that's for sure.
Yeah, and like I say, if the dollar does pick up steam, probably this would not do as well as it might do. But again, I think it's,
Sure.
like it's if you bought a biotech stock or a tech stock and you were early, it might turn out to be a big thing. But
Mhm.
the people that are involved and the people who talk the story and the concept of digital currency versus paper currency, you
Mhm.
gotta figure we're going more in that direction than
Sure.
back to passbook savings. You know what I mean?
Right. No, absolutely.
Last one is going to be on corn, because you were talking about some markets that people get into because they are somewhat slower. Today it's up 15 cents, so you can throw that concept out the window.
Mhm.
But
Right. Yeah.
a lot of times it doesn't move quite as fast. Soybean oil is another one, and so
Yep.
sometimes. But let's look at corn, and just so people get a
Okay.
little idea of if they wanted to take a look at something a little slower.
Sure. Yeah, corn is a really good one for beginning traders, especially beginning option traders, because the options tend to be cheap, and you can just kind of dip your toe in and get a feel for things and that sort of
Hmm.
stuff. So I agree, it's a good one to look at. Corn is basically trading sideways from 2015 through now. So for 5 years, we've basically traded sideways. However, there have been a few exceptions where we've popped above 4. You can see we're in the midst of one of those now. Um, it never has held. Most of the time, it holds $4. A few times it breaks above, and then it eventually collapses. You can see this is a weekly chart, so you can see like this time it took 4 weeks before it finally just completely collapsed. This time was about 2 weeks, 3 weeks. Over here, we've got maybe 2 months before it finally does it. So my bet is that corn's probably not going to hold these highs again. I probably wouldn't recommend you sell the futures contract because that's a dangerous game. I mean, you can, but you just have to be willing to accept the fact that you might have to ride it to 460,
Hmm.
470, and that's not going to be necessarily pleasant. Um, but you can buy cheap put options in March that have almost 4 months to expiration for less than $500 and just see what happens. And that's probably how I would play it, because history suggests that $4 corn hasn't lasted.
Well, it also looks as if the market tends to roll over as we go into the planting season of May, June, July. So that might be something to keep on your
Mhm.
calendar. If this thing can remain
Sure.
strong for the next 90 days, the following 90 days might be,
Yep.
or the next 3 to 4 months, it could be
You're
followed by something. Yeah.
sure, you're exactly right. So usually we generally top out mid-summer, late summer, sometimes
Mhm.
early summer, but we generally top out in the summer, and then we usually make some sort of a trough in October, which is when corn's harvested. This year, honestly, we didn't play the grains very well at all this year. We initially started out with bullish trades. They did great. And then we tried to flip it too early, and it didn't work. Luckily, we had limited risk options. Otherwise, it might have gotten ugly. But the reason we did that is this is really unusual for the market to rally during this time of year. I mean, very unusual. So those sorts
Well, I
of
think
things
it's
can
probably the
happen.
China buying, that had to be
Sure.
done before a certain date to
Yep.
comply to phase 1 or whatever it was, right?
Exactly. No, that was a huge part of it.
Yeah.
But yeah. So
All right.
sometimes,
Well, here's the deal, Carly. We're at the top of the hour. Could you
okay.
remind people about the Bloomberg appearance you're going to get so they could put it on their calendar for tomorrow? And then also, if you have any, obviously, how to get a hold of you and how they could expand their knowledge in this sector called futures.
Sure. Yeah. So we are going to. It's a short segment on Bloomberg. It's hosted by Abigail Doolittle. It's called Options Insight, and it starts at 3:15 Eastern. And I do it about once a week on various days. I'm going to share a different screen with you so you can see my contact info.
That's good. Yep. Oh,
Whoops.
there it
I'm
goes.
sorry, hit the wrong one. There we go. So this is me. If you have any questions, or if there's anything we can do for you, you can let us know. Again, we are commodity brokers. That's what we do. DeCarley Trading is our website, decarleytrading.com. You'll find all kinds of free information, videos, So the idea is we're brokers, but we want people to understand what they're getting into before they actually get in, because commodity trading is risky. It's not like buying a mutual fund and collecting dividends. I do also want to point out, oops, that's my dog, by the way. If you want to learn more about trading commodities, I've written multiple books. If you go to Amazon, you'll find about 7, but ignore the others. These are the only 3 you need to know. The others were with older publishers and they're kind of out of date. So if you're interested in learning, I recommend starting with a trader's first book on commodities. That's the ground level. And then higher probability commodity trading gets into market analysis and things like that. And then trading commodity options just came out this year. And obviously it's all about trading options and spreads and things like that.
That's perfect. Okay, so that's how they can get a hold of you, and also they could get a hold of the knowledge base as well, which is perfect. It's always great talking to you, Carley. I think we certainly gave everyone a run for their money today with going over quite a bit of information, and thank you for taking time out, and we'll talk to you soon. I'm going to send it back over to David. Before I do, for Option Professor, if you'd like to get our weekly free market update, you simply go to our website, optionprofessor.com, and put your email in. And then each week we send out the free weekly update on all the different markets. Again, thanks a lot, Carley. And David, back to you.
Thank you.
All right. Yeah, lots of good info today. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory or app to get instant updates on all the future shows and events. You can also go to TimingResearch.com and to get access to the archive of this presentation as soon as I can get it posted, or any of the past shows or presentations. So I just want to thank my guests again for today, Carley Garner of CarleyTrading.com and the Option Professor at OptionProfessor.com. Thanks, everyone.